I
Yeah.
have also deleted Twitter off of my phone, so I am less present and aware of what's going on
Oh,
that
yeah.
app. And
Okay.
I haven't looked back. I still check it once in a while. I didn't fully delete it. I just deleted it.
1, 2, 3, 4.
All opinions expressed by Chris, Michael, and Ryan are solely their own opinions and do not reflect the opinions of 5i Research or i2i Capital Management. This podcast is for informational purposes only and should not be relied upon for any investment decisions. Employees of 5i Research may hold positions in the securities discussed in this podcast. Hey everyone, before we dive in, just a quick note. We had some unexpected technical difficulties with the audio during this episode. You might notice a few moments where the sound isn't as clear as usual. We truly appreciate your patience and understanding, and we promise future episodes will be back to our normal quality. Thanks for sticking with us. Now let's get into the show.
Welcome to the 14th episode of The Exponent with 5i Research. My name is Chris. I'm the head of research with 5i, and I want to welcome you, our listeners, to our journey into the heart of the Canadian markets. Our mission is to empower investors with precise insights and in-depth research into stocks, the economy, and more. With that said, let's dive into the Canadian and U.S. financial landscape. So today I'm joined by my co-host Ryan. Welcome, Ryan.
Always fun to be here.
Yeah, no, it's been a bit of time since we last spoke, but we have a pretty jam-packed agenda today, so I want to just get things going here.
Yeah, it was nice. It was a bit of a, usually you always want a bit of a rest time over the summer and you don't get it with the markets, but I feel like this past summer actually was relatively quiet, at least relative to the past years we've had and stuff. So
Yeah.
call it on the headline macro type of news front. Not a whole lot going on, which is nice. But on the earnings side of things, obviously we got through earnings season in July and August, and earnings looked pretty good. S&P 500, I think about 81% of companies had a positive earnings surprise that reported. So good stat there. Earnings growth is also, call it 12% on the for year over year, and that's their third consecutive double-digit growth for companies on the S&P 500. So those are, you have a lot of companies beating expectations, but you also have pretty good earnings growth as well, which is nice to see.
Okay, and then we're gonna head to the next section here. So next, this is a new one. I want to talk about tweets of the week. So I've pulled up 2 tweets here. So the first one is from JC Peretz. Shout out JC. So he mentions, small caps versus mega cap tech. Who do you got? So the first panel, the top one here, this is looking at small caps performance relative to the NASDAQ. So it's Russell 2000 against the NASDAQ. And then in the bottom pane, we have relative strength. So that's the RSI. And so this is what like the technical analysts of the world call like a hidden bullish divergence. So essentially the top panel is moving down. So that means that Russell 2000 small caps are underperforming relative to large caps over the last year or so. But underneath the surface, the RSI, which is kind of like a momentum indicator, is actually improving. So when we look at this across different metrics, it's called a bullish divergence, but it essentially means that even though on the surface level, small caps are underperforming large caps, there's actually some hidden kind of strength underneath the surface, and that's being shown through the RSI. So that's really interesting. I think that could play into some potential near-term or long-term strength coming out of small caps. And it's certainly something to watch. And then kind of in tandem with that, we have a tweet from Seth Golden, and here he's talking about, he has a proprietary model on the what he calls like smart money in the futures markets, and it's for the Russell. And essentially a couple of weeks ago, it triggered a double buy. So it was on, a buy signal on both his short-term and long-term signal for the Russell 2000 small caps. So he flagged that as interesting. So I thought between these 2 tweets, that was quite interesting to see a lot of these like hidden sort of underlying strength indicators coming out of small caps, and also just noticing the relative strength at the surface level. I mean, Russell 2000 names have been performing quite well, whereas NASDAQ's been pretty good as well, but a little bit choppy. And I think we're pretty overdue for like a small cap run here. So I think a lot of signals are starting to flash that, we could see some sort of like strength come out of US small caps.
It's nice to see the space getting a bit of attention too. It's been a 5-year, 4 years, essentially sideways market there, which I think a lot of people don't realize. So a catch-up trade certainly wouldn't be out of the question, I think, there.
Mm-hmm. Yeah.
I have also deleted Twitter off of my phone, so I am less present and aware of what's going on.
Oh yeah. Okay.
I haven't looked back. I still check it once in a while. I didn't fully delete it. I just deleted it off the home screen. But,
really? That's interesting. Okay.
I recommend it. It's a bit of a game changer. Yeah.
That's pretty much my go-to, like my only source. So that's I don't know if I could do it. I mean, you're right. It's probably
so toxic.
A bit of a benefit for the mental health, but okay. So that's tweets of the week. So I think next you wanted to go over some noteworthy dividend cuts and raises in Canada.
Yeah. So 3 kind of main ones to highlight here that jumped out at me. Barrick Mining, ticker ABX, did a 50% increase in their dividend. And no surprise what's going on here, right? Gold prices have been up and to the right for the last year. And obviously higher gold prices mean all the gold mining companies get higher revenues and higher profits. So higher earnings means more of an ability to pay more dividends. So they increased their dividend by 50%. Their earnings in the last quarter jumped from 37 cents to $1.12. So they're obviously seeing a lot of the benefits from higher gold prices here. So nice increase in the dividend there. No real surprises, I guess, though. On the kind of the opposite on the spectrum was Algoma Steel. They suspended their dividend, and kind of similar to ABX, where it shouldn't be too much of a surprise because they did it because of tariffs. So a lot of tariffs out there, a lot of uncertainty. So they decided to make a prudent move and just suspend the dividend for the time being until they have a bit more clarity on kind of what their outlook looks like. So probably not an ideal move if you're an investor, but it's probably the right move for the company to do that as well. And then the final one, more of a benign dividend increase here, but I think it's some moves going on at the company are interesting to note. It's an open text, ticker is OTEX, OTEX. They raised it by 4.7%. And so again, the raise, that's interesting, but in that same quarter where they did the dividend increase, they also announced the removal of the CEO, who's been there for quite some time. And honestly, the stock hasn't done a whole lot over the last couple of years, so the removal was probably overdue. And the company's trading like 7 times forward earnings right now. I mean, they're a very substantial tech company in Canada, right? So, whoever, there's an interim CEO right now, and my guess is that whoever comes in to replace them should have a couple lob balls they can hit to get things moving at the company, given where it's trading at valuation wise. So it could be one to watch on that side of things. For MoneySaver too, we did just release the September issue, and I'm a big fan of the theme in this issue. It's focused on kind of back to basics, but it's not call it basic concept. It's more about getting back to those key, basic but important financial decisions that you make in your life, right? So yeah, the simple decisions like focusing on, do you want to use an advisor, and understanding what different types of advisors there are. Basic seeming decision, but very large long-term implications in that decision, right? Same if we talk a bit about debt and the right types of debt to take on. Again, everyone's going to assume a mortgage, whatever it is, or some sort of credit line. Call it a basic. Everyone knows that debt is bad, cash is good, but you just kind of need to get those decisions right and understand the difference between good and bad debt too over time. Right?
It's critical.
So it's back to basics, but it's just sort of almost taking a step back and making sure that you have all those important key pillars set up in the right way, or that you've at least like thought about them, kind of thing. So good issue on that side of things. And we also talk a bit about wills as well, which is another really important topic, but gets overlooked a lot just because I think it's kind of a scary topic, right? Nobody really wants to talk about their ultimate demise, particularly with their families and things like that. So just good theme overall with the issue that we're pretty happy about, I think.
So the next section that we're going to be talking about is some interesting questions from 5i Research's Q&A section. So I'm going to be going through a couple questions that I found interesting, and also Ryan will be discussing two that he found. So the first one here. So this member asked, hi there, if you had to buy 3 Canadian and 3 US stocks today that you feel have multi-bagger potential, looking out 5 to 10 years, which stocks would they be? Not looking for names that have a decent chance of going to zero either, however. So the multi-bagger question is certainly a good one. And, essentially I want to highlight that not all multi-bagger stocks need to be high risk necessarily. So we can see, multi-baggers happen over the course of 7 years if a stock is just growing at 10% each year, which is pretty achievable for a lot of stocks. And above that, then the time frame just shortens. But our response is essentially that, of course, multi-baggers are difficult to predict in advance, and most multi-baggers come with significant volatility and the potential to see drawdowns of 70+%. But, for that moderate multi-bagger type name, so it's not exactly shooting for the moon, we think the following can perform well in the coming years alongside some significant volatility. So on the Canadian side, we have Galaxy Digital, which is GLXY, Celestica, CLS, and then Shopify Shop. And then we have some US names there. So, I thought this was really interesting. And, we always look at multi-baggers, but I wanted to highlight some of these core stocks that have, high historical levels of volatility, high historical returns on their stocks, but also, huge PEs. Some of them might not even be profitable. And, we often see large valuations on these, but also large drawdowns. So I think it's really important for investors that are looking for multi-baggers to also acknowledge that volatility and understanding 70+% is quite normal. And just by using Celestica as an example here. So this is a chart of Celestica's price action. So it's in the top panel. And then in the bottom is the drawdowns. So this is over the past 3 years. So, Celestica's up 1,500% in the last 3 years. So multi-bagger status, but it's had 520+% drawdowns in 3 years. So pretty significant. So I think investors that are looking for those multi-baggers really need to come to terms with what a multi-bagger comes with, and can they withstand all of those 20+% drawdowns, especially back-to-back drawdowns. So it's pretty significant, but this is kind of the classic formula for a compounder and a multi-bagger.
I've never been a big fan of the framing of looking for a multi-bagger, because I think it just sets an investor up for failure, right? Because immediately you start to think about speculation and risk, I think, when you think about the idea of these exponential returns, right? And so then you start looking just in maybe high debt companies, probably negative earnings companies, whatever it is, super small micro cap companies, and all those things can work, but it doesn't need to be. And I think a lot of people forget that's you can just find a really solid company with a good long-term growth profile, and it might take a couple of years, but they can multi-bag over a 3 or 5 year period, especially if you kind of get things right? I think when people start looking for them, then they start to they look for the wrong things, and they look for the wrong risks, And I think oftentimes it sets up, like obviously every stock you own, you hope that's gonna be up hundreds of %, right? That'd be a great outcome.
Yeah.
But oftentimes it can be the ones you least expect, or you just look back after a 10-year period or a 5-year period and it's like, oh wow, this stock has gone up exponentially and I barely even noticed it. It's just kind of compounded over that time, kind of maybe you had 1 or 2 really good years or whatever. But it's I think you always kind of have to check yourself a bit when you're looking for those kind of names, because oftentimes it's not the ones you necessarily expect either. I mean, when CLS was a down and out stock for years and years, right? And then the AI stuff came and it really helped them out, obviously. But they traded at, I think, 10 times forward earnings on a regular basis. A low margin, low growth company kind of thing, right? And obviously things turn, but that wouldn't have been a name you would, in hindsight, look and say, oh yeah, CLS.
Yeah, that's right.
It just wasn't, kind of thing, right?
Yeah.
So it's just, I think you have to be careful with that, the framing of looking for those really multi-bagger names, to make sure you're not getting yourself into something too speculative or high risk, because it's you don't need to do that to find those names, right?
Yeah, I like that framing of like looking for those names, because I think you're right that like when investors look for multi-baggers, they often like seek them out and then they'll try to gain conviction in that name, like almost artificially. But if you can find a name that is both high growth, something that you have conviction in, you're familiar with at least the theme or the company, you can kind of develop this like well-rounded set of like both have conviction and it's something that actually could multi-bag. So you can, and it helps with like holding through those drawdowns. But if investors just seek something out that's small cap, that, one time had this huge single day gain of like 30% or something, and they try and replicate it, they're almost like forcing themselves into owning a stock that, 3 years from now, they likely don't want to keep owning. So yeah, I like that framework.
Sure. I think we probably hit our threshold for the word multi-bag in this episode too. So
hit that buzzword. Yeah. Hashtag. All right. So I'll move on to my second question here. So this one comes from Clayton. So he says, everyone, if you could only listen to one Canadian and one American commentator beside yourself about business, who are those people? Clayton. So also shout out to Clayton, because I do see that he has a lot of really interesting questions on the queue. So I like that. And so, we said it's a tough choice. There's, a lot of commentators that we like, and we like to gather data points by listening to many different individuals out there. But when we look for signal, especially on the broader markets, essentially, at least in terms of myself, I like, on the US side, Tom Lee. I think he's got a lot of like data-driven insights, which have historically proven to be pretty on the nose and accurate in what he says. And then for Canada, Barry Schwartz. So he also has some really great comments on the market. So just wanted to shout out to all of those broad market analysts and everyone else out there. So yeah,
only list of 2 people. That's all we could come up with on that one. Right? That's a pretty irreverent list, I guess. There you go.
Yeah, just only 2 people. That's pure signal. No, okay. Okay, yeah. So on to your questions there.
Yeah. So I never set up with the screen stuff like you are, unfortunately. So. Okay, the first one is, will AI make software applications obsolete in the future? And the answer is probably not. But it's a good question, because over the last year, actually no, probably last 6 months or so, there's this whole theme and theory about AI eating software, and you've actually seen software companies in general have lagged other areas of the market. So it's the sentiment and the narrative is certainly a real one, and you can see that in a bunch of different companies out there. But I think it's a really misguided view on what's happening here. And there's a few reasons to kind of, and I wrote about this over at the I2I website, but I think there's a few kind of core pieces where it's just missing the mark of this idea that AI is going to eat everything and eat all of software. So one of the main concerns people often levy is competition, right? So now anybody can make software. You and me can ask ChatGPT to make something, and it'll just spin up a program on its own. Fine, but I think people miss that software's always been super competitive. It's always been relatively easy to make an app or a business, online business, or whatever it is. It's just kind of another case of it's just a bit more competitive now, and it's accelerated a bit more. But that's always been the case, right? It was never like it was super hard to program. You needed a certain knowledge base and all that kind of stuff. But it's just kind of getting more intense, certainly. But that was never lack of competition was never the called the bull case for software companies. So that's why first mover advantage has always been so important, right? You get big, you get all the market share that you can to begin with, get people kind of locked into your service, and then there's not much incentive to move over to something else unless it's 3 times better than whatever the service that's being provided, right? Or if you're for what a lot of large companies do is they get big enough, they get scale, and then they just crowd out the competition. They bid up the advertising rates online, things like that, so you can't even get your product in front of people to check it out because it's too expensive to advertise, whatever it is, right? But the competition's always been there in software. So that's, yes, maybe it's a bit more intense now with kind of AI making things that much easier. But it's that story hasn't changed at all, I don't think, really.
Yeah, no, definitely. I think, in the short term, it might, cause some disruption, but certainly over the long term, I mean, anyone with some sort of like software engineering background is just going to be able to know how to utilize and take advantage of AI systems that much better than the average person. And we're really seeing like AI, is just overtaking all of these, these giants for their software, for their coding anyway. So like all these companies are utilizing AI to code, and I think that eventually that causes, someone is going to be monitoring that or making it more creative in some way. And so I think you're going to have like human intervention for sure.
Well, I mean, on the other side of it, someone needs to build those tools
right
to begin with, and it's probably going to be the incumbent software companies that build these enhanced tools with AI or whatever it is, right? So that's one thing. But then the other kind of issue that people are worried about, AI taking over software, is this idea of in-housing. So institutions are going to start building in-house teams that create all this AI software and replaces their current software. And I think it's if you've ever worked in a big company, I think you just know that is just a very, like, I don't want to say silly, but just a really out there theory that large institutions are just going to rip out their decades old, technical
architecture,
architecture or whatever, right, and then just replace it with AI, with like these single points of failure of Joe from IT that built this random AI tool, and he's away on vacation, but meanwhile it crashed. What are we going to do, kind of thing, right? Like, it's just, I don't think it's going to happen. Companies want to outsource stuff, right? They want to focus on what they're good at, which is selling their product or good or service, whatever it is. They don't want to have to be the ones worrying about uptime on their website or different software tools or whatever. And it's nice that when something goes wrong, because things always go wrong, that you can turn to a software company XYZ that you pay a lot of money to and scream at them and their team of thousands of people to go and figure out what that issue is and fix it, right? So again, I think the whole thing of AI just totally taking over software is maybe a bit misguided. And then the other one, this one maybe has a bit more credence, but it's the idea of lower margins. So I think there's some case to be had here where, if you're a software company, you're going to your customer to renew your product, and they say, well, you know what, maybe we'll try to just AI this tool instead. So maybe then you get a bit more, you sharpen your pencil on price a little bit, and your margins come down to say, don't do that, just renew, we'll drop our price a bit, you don't have to worry about trying to do it yourself in-house or whatever. So it could be a case there. The thing on the other side of that is that those same software companies can also use AI tools to
Right.
improve their own margins, to decrease costs, or to go to their vendors and say, we're going to use AI to do the services you provide. Right? So it's kind of turtles all the way down a little bit, I think, too, where maybe there's a case for lower margins, but there's probably offsets to those low margin case as well. So there's definitely a lot going on in the whole AI software debate, but I just think this idea that AI is going to totally eat the software industry is a little bit out there. Just like how it's going to create some job displacement for sure, but we're not all going to be unemployed as a total society, just hoping AI does everything for us or whatever, right?
So. Yeah. No, it's a really good point. Really pertinent one for today, but I definitely agree. Yeah. I think, and for anyone that's worried about that, I mean, the investment thesis for me is kind of simple. It's, own the AI hardware names if everyone's really worried about AI kind of overtaking everything. And then if there's even a little bit of doubt, I mean, it's own AI hardware plus own the software in case that thesis doesn't pan out, and then those could re-rate higher after all this sentiment shift. So it's kind of a nice natural hedge.
Sure. The other question to highlight, I guess, is a bit of a longer one. I'll summarize it here. Given the markets have continued to reach all-time highs, do you view the market as somewhat frothy or full-on frothy, and how do you kind of position or deal with that? So, every time markets, we were talking a bit about this earlier. Every time markets have a bit of a run, everyone starts to talk about, it's frothy. Stocks are up, markets are up 5%. It's there's no logic to it or whatever. But I think the real issue is that you just see, like, nowadays everyone's just way more connected. It's way easier to pull up prices, see movers, whatever it is on an app on your phone kind of thing. So I think, call it the frothiness or the meme stuff that everybody always points to. I think that was always there. It was always in the background. It's just, you just didn't see it as much.
Just changed basically from what it was.
It's just more in your face now. You hear about it more now. I mean, sure, there's like stock boards and stuff that talk about it or whatever. But I don't think that type of stuff is a whole lot different from what went on 5, 10, 20 years ago.
Yeah.
So I wouldn't point to that and be like, oh yes, markets are very frothy because you have some meme stock stuff going on or whatever. Nor do I think it seems that frothy regardless, right? It seems you kind of have in a lot of cases, markets kind of moving higher over a daily, weekly, monthly basis, whatever it is, but they're having some drawdowns, some pullbacks, all that kind of stuff. So it seems largely healthy, right? Like it's when I look out across the landscape, it's hard to point to, I think, things that are just obviously way out there or illogical disconnects. Our market's valued at a premium right now.
Right.
Of course they are. Yeah, there's reasons to justify that. Are they at levels that's just where you can't justify it over a 3 or 5 year period? Probably not. And always, there's always going to be another recession down the road at some point, kind of thing. And sure, markets will look expensive whenever that happens, but that might not happen hopefully it doesn't happen for another 5 or 10 years or whatever it is, right? So it's just, things don't look too frothy or too irrational out there to me at this point. I think to kind of deal with that, it's just your best defense against that kind of concern. Markets continue running, they're at all-time highs, all that kind of thing. It's just prudent portfolio management, right? It's just rebalance. If it's a single position that's become a large part of your portfolio, trim it down, rebalance that into maybe something that's underperformed a bit, or rebalance into maybe more of a defensive type of space, fixed income, whatever that is. Check your geographic allocations. Maybe a certain geography has really taken off, like maybe Europe has done well. And I think maybe you want to rebalance out of that into another area. And then on the equity and fixed income, if equities become too much of your portfolio, maybe it's time to balance that out and rebalance that out and trim a bit and add to fixed income or something like that. So it's not like a sexy answer of what to do when markets are running. It's just but that really is kind of over time, I think the right answer is just be prudent about it. Don't let any single thing get too out of hand in your portfolio, and just rebalance. Take some of the gains off the table and move it into maybe something that hasn't done quite as well, or something a bit more defensive, particularly if you're kind of worried about it. But I don't think I think the setup, the outlook for the market still looks pretty good. It's hard to see. There's always something that could come up, but it's hard to see something obvious in our faces that is going to really take markets down from here. You may have interest rates are probably going to come down a bit more. Economic growth in the U.S. looks okay. You got maybe some job weakness to be concerned about, but earnings were just good in U.S. and Canada as well, which is kind of gives you that really near-term data point also. So, things don't look too bad right now.
Yeah. No, I definitely agree. And yeah, I think one sign that we're really not seeing froth is that there is still like a lot of investor skepticism out there. Investors aren't quite sure about this. Some might be looking for cash or to, stow away some of those profits and put them into some sort of like money market fund or go defensive. And, I think that usually things are quite frothy when no one wants to admit that it's frothy. But when everyone's asking about, is this frothy? They're really just looking at a segment of the market that's doing really well that they likely don't own. And so they're questioning the overall health of the market at that point.
Yeah, I think that's fair.
Cool. And okay. So then next, I'm going to be highlighting a recent 5i report that we've done. So this is TMX Group Limited. The ticker is just X. And yeah, we have this at a highly rated scoring as part of our report updates. And essentially, TMX, it's an exchange facilitator and clearinghouse for the capital markets in North America. It started out as a capital exchange, but it's grown into like data analytics, insight solutions, and index service. And that's been happening over the years. And so now those, more service-based kind of segments have become a large portion of the business. And it's mostly known for the famous exchanges such as, the Toronto Stock Exchange, TSX Venture. But it recently acquired Verify, which is furthering its reach into the ETF ecosystem. And overall, the data analytics segment is, it's just this like high margin, recurring revenue kind of business. It's a lot less cyclical than just trading volumes, which it was mostly seeing through like the TSX and TSXV. It's a classic compounder name. It's compounded its earnings by double digits and grew its dividends at similar rates over the years. And it's really transitioned into a company with a diverse portfolio of different businesses. So its valuation, though, can be considered high at 26 times forward earnings, 9 times sales, 3 times book. But we feel that's justified given the quality of the business, especially its business mix shift into that services segment. So yeah, it's compounded returns at 22% over the past 10 years. Analyst sales and earnings estimates are rising. It even pays like a decent yield at 1.6%. And it's grown its dividends at a 9% annualized return over the last 10 years. So a really strong, healthy name in the Canadian financial sphere that's not necessarily like, it's not an insurance name, it's not a bank. It's kind of a data analytics provider and capital markets kind of name. So yeah, really interesting name for Canadians to look at. And obviously the performance has been great over the years.
So we're moving into our investor education segment, I think now.
Yes.
So yeah, so we're going to talk, it's called a basic building block, but I think to a lot of people might not be obvious either. So we're going to talk a bit about price to earnings ratio, PE, what it is, and how to build maybe a target price target with it. So quick and dirty overview of the price to earnings ratio. So obviously it's I shouldn't say obviously, but it's the share price divided by the earnings per share for the company, and that gives you kind of that PE multiple. And earnings per share is your earnings or your net income divided by your shares outstanding. And so the calculation there is pretty straightforward. And I think what a lot of people do when they look at the price earnings ratio is they use the trailing PE ratio. You need to be careful of this. Like when you're looking at it, if you're using kind of a public website that gives you this data, it's you can get a pretty big difference between a trailing and a forward PE. And I think often like a lot of sites actually use the trailing number, and really it's just not useful. It's looking backwards. It's everything in the trailing PE is behind it already. Markets are always forward looking, so you really want to use that forward number. And a good example of this is, maybe there's a company that just, yesterday they signed a big contract and their earnings are going to double because of that. So obviously, let's just keep it simple. If earnings are doubling, the stock probably doubled with that news. So if you look at the trailing PE ratio, it's going to be on earnings before that doubling of EPS. Meanwhile, the stock price has doubled as well. So you're going to just have a really high PE ratio. You're going to be turned off by it, and it's not going to make any sense. But it's not up-to-date information. It doesn't really make a whole lot of sense to use that trailing multiple. Meanwhile, on a forward basis, now in fairness, it might take some time for that forward number to update, like that earnings number to update. But regardless, the forward PE multiple is going to actually capture that growth better. It's going to be more of a, not real time, but more of a forward-looking metric for you, right? So you really want to use forward PE any way you can, and be aware of if you're, using kind of public data services that you might be not looking at the right type of PE ratio. So something to keep in mind on that side of things. And so if you want to take the PE ratio and build a bit of a price target out of it, and there's kind of two simple ways you can do it. One is you can estimate your own earnings per share. So maybe you think earnings are going to be something different than what everyone else thinks and everyone else is forecasting. So you can take that earnings per share and multiply it by your PE multiple, and that's going to give you your price target. So quick example there, maybe it's a company you think is going to have $2 in earnings, and they typically trade at a 10 times price to earnings ratio. 2 times 10 is going to give you a $20 price target for that company. On the other side of it, maybe you want to estimate your own PE multiple. So maybe it's a stock that trades at 5 times earnings, but all their peers are trading at 10 times. And maybe you think it should actually trade at 20 times earnings for various reasons that the market's missing. So you can take whatever that forecasted earnings number is. Let's say it's a $2 earnings number. And you can apply your 20x PE because you think that they're growing faster or they're doing something better than their competition, and that's going to get you your $40 price target. Or you can blend two approaches. You can, if you think you have a bit of edge on forecasting the earnings, and it's also not trading at the right multiple, you can kind of combine those two things. So so I think just a way to use the PE multiple and kind of understand how to think about it. And if you kind of want to build your own price targets, kind of a quick and easy, simple way to do that as well, using that. So
nice, I like it. Yeah, good primer on PE ratios, and especially really interesting and relevant for like going on any sort of data platform because they do mostly show like the trailing 12-month PE, and it is curious that not many showcase right away the forward PE, but that's certainly the metrics that we most heavily rely on at 5i Research. That's what we find most insightful and useful. So yeah, definitely some good investor education there. And if members or the audience hasn't checked out the site or wants to check out forward PEs, they can come to our site and we can provide them with some of that data as well. Okay, cool. So I think that's all that we have for today. We hope you enjoyed this episode of our podcast and learned something new about the Canadian and US markets. If you want access to more exclusive content and insights, don't forget to visit our website at 5iresearch.ca and sign up for a free trial if you haven't already. You can find the link in the show notes below. And if you like this episode, please give us a thumbs up and subscribe to our channel for more updates. Thank you for listening, and we'll see you next time.